hold on to your portfolios. Today's video features stunning insights from industry experts on rapidly rising gold prices, tech stock strategies, and the Fed's true influence on the economy. Wondering why Tesla, IRFC, and Broadcom are making bold moves? Or what AI's rise means for you? Stay tuned to hear how these factors could reshape your financial future. Plus, don't miss Nomi Prins' bold prediction for gold hitting $3,000. Like and subscribe to stay updated on critical finance news. What videos we'll be covering in today's episode.
First up, Bob Quartermain explains why, despite soaring gold prices, mining margins are getting squeezed. Next, Nomi Prins reveals why the Fed isn't as powerful as it seems and forecasts gold to hit $3,000. Then, Brodie dives into Warren Buffett's cash strategy and the implications of current Fed rates. Finally, Jay Jacobs outlines how AI gains are set to trickle down from big tech to the rest of the market.
First up, Bob Quartermain explains why, despite soaring gold prices, mining margins are getting squeezed. Next, Nomi Prins reveals why the Fed isn't as powerful as it seems and forecasts gold to hit $3,000. Then, Brodie dives into Warren Buffett's cash strategy and the implications of current Fed rates. Finally, Jay Jacobs outlines how AI gains are set to trickle down from big tech to the rest of the market. Welcome to Kitco News on YouTube. Today's main event: gold prices glitter while mining margins get hammered. We're discussing highlights from Bob Quartermain, Dakota Gold's director, live from the Rick Rule Symposium in sunny Boca Raton, Florida.
Absolutely. Bob dives into the paradox of gold soaring to new heights while mining margins play a brutal game of limbo. Ready to explore this golden dilemma? Let's dig in, carefully.
So, what's the golden nugget from Bob Quartermain's interview?
The core thesis is that despite the shiny allure of soaring gold prices, miners are feeling the squeeze from rising costs. It's a classic riches to rags story in the mining world.
Let's unpack those key points from Bob. How's the mood at the symposium?
Optimistic, to say the least. High gold prices have investors buzzing. They're well-informed and hungry for details on drilling results and project specifics. It's like a gold rush, minus the pickaxes.
Speaking of high prices, what's going on with margins?
Even with gold prices glittering at all-time highs, miners are squeezed by inflation. Costs are ballooning to $1,300 to $1,400 per ounce. It's like finding gold, but losing your fortune on the way back.
Yikes, and the junior miners?
Junior miners are in a tight spot, struggling to raise capital. It's a game of survival of the fittest projects, and it's tough out there.
What's driving demand for gold besides bullion bars under mattresses?
Central banks are hoarding gold, and then there's the tech industry. AI and electronics are gobbling up more gold than ever before. Robots need their bling too.
What about the green transition?
The push for a greener world means more mining, especially for rare earth metals. But we need regulatory support to fast-track these projects. It's like green lights stuck at red.
Crystal ball time. What does Bob say about the future of gold prices?
Gold prices are set to keep climbing, driven by tech and central bank purchases. Looks like this glitter train isn't stopping anytime soon.
And in terms of industry trends?
Expect more mergers and acquisitions. Efficiency and resource optimization will drive the sector, like miners linking arms to cross a rugged path.
Wrapping up, what's the final takeaway from Bob's insights?
Bob emphasizes the need to educate the public on mining's essential role, demands for political and regulatory support, and the importance of strategic partnerships. The future of mining shines bright, but it needs support to keep glittering responsibly.
Welcome to Kitco News. Today, we're delving into some of the latest hot takes with the ever-insightful Nomi Prins. So get ready. It's Fed chaos, gold fever, and economic turmoil.
Absolutely. Nomi Prins gives us the lowdown on why the Fed's losing its grip and why gold is set to soar to $3,000. Buckle up. It's going to be a wild ride.
All right, let's hit the ground running. What's the main takeaway from this gold mine of a chat with Nomi Prins?
The core thesis is that the Fed's got its hands tied. It can't control inflation or the job market as it claims. Meanwhile, Nomi predicts gold is headed for a dazzling $3,000 thanks to global economic uncertainties and shifting power dynamics.
Intriguing. Let's break that down. Starting with the Fed's role, what's the scoop?
Nomi asserts the Fed can't fully control inflation or the job market. Other central banks are now more focused on their own economies and supply chains, shifting away from collective action.
All right, so the Fed's struggling. What about the economy's current status?
Oh, it's a roller coaster. Unemployment is over 4%, the highest since 2017, and housing prices are soaring, putting pressure on both individuals and the banking system.
Sounds pretty dire. What does Nomi say about inflation?
She says the Fed's 2% inflation target is out of sync with reality. Despite some stabilization, prices remain stubbornly high, and the Fed is largely powerless to change that.
Yikes. And what's the situation with commercial real estate?
Nomi warns that delinquencies are rising faster than before the 2008 crisis. This initially impacts regional banks, but could cause ripples through the entire banking system.
Ouch. Now let's get to the glitter. Gold and silver. What's the buzz there?
Gold is nearing $2,400, moving closer to Nomi's $3,000 per ounce prediction. Retail investors are jumping in, spurred by fears over the banking system. Silver is also gaining ground, in part due to its utility in the energy sector.
Crystal ball time. What are Nomi's key predictions?
First, she's sticking to her guns. Gold will hit $3,000 by year's end, driven by ongoing economic uncertainty. Second, she's forecasting further banking instability, especially if commercial real estate issues worsen.
Wrapping it up, what are the big takeaways?
Nomi suggests playing it safe with smart economic policies and keeping a close eye on gold and silver for secure, potentially lucrative investments. As she says, the Fed and central banks are increasingly out of their depth.
Welcome to David Lynn's YouTube channel. Today's episode is packed with economic insights from Brodie, VP of Strategy at Moomoo Canada. We've got a lot to unpack, so let's dive in.
Absolutely. We're talking high interest rates, Fed policies, and even Warren Buffett's massive cash stockpile. This isn't just coffee shop chatter. These issues impact your wallet.
So, what's the big idea here? What's the core thesis from Derek's interview?
The main takeaway is why Warren Buffett's Berkshire Hathaway is hoarding a record $189 billion in cash. Derek also dives into the Fed's stance on sticking to high interest rates until they're convinced inflation will hit 2%.
Let's start with the Fed's position on interest rates. What's going on with that?
Well, the Fed is hesitant to cut rates without proof that inflation is trending toward 2%. Nominal wage growth is slowing, and they're concerned about potential layoffs as the labor market cools down.
Interesting. And how do the U.S. and Canadian economies stack up against each other?
The U.S. is currently outperforming Canada. U.S. GDP is at 2.8% versus Canada's 1.7%, and their unemployment numbers are better. However, Canada's inflation rate is stubbornly sticking around 2.9%.
Now let's touch on the stock market. Is it as rosy as it seems?
Not exactly. The S&P 500 is climbing largely due to tech stocks like Nvidia. Derek warns this creates a misleading illusion of overall market health, masking underlying economic issues.
Got it. What about consumer spending and retailer price cuts?
Retailers cutting prices could indicate future margin pressures. While consumers are resilient now, this trend isn't sustainable indefinitely.
Finally, what's up with Warren Buffett's record cash pile?
Berkshire Hathaway's $189 billion in cash isn't a harbinger of doom. Derek suggests it's part of Buffett's disciplined strategy to deploy capital when the timing is right.
All right, time to look into the crystal ball. What predictions did Derek share?
First, the Fed will likely adopt a slow rate cut approach, dipping to 5.1% by this year's end, 4.1% by 2025, and 3.1% by 2026. Second, consumer spending might take a hit, and tech stocks may face a potential pullback.
Wrapping it all up, what's the end game here?
Derek underscores the importance of a balanced and diversified investment portfolio. He stresses disciplined long-term strategies a la Warren Buffett and urges caution against chasing short-term trends.
Hello and welcome to the Public App YouTube channel. Today, we've got something really special lined up.
That's right. We're recapping an episode of the Leading Indicator podcast where Jay Jacobs from BlackRock dives into how AI and geopolitics are shaking up the market.
So what's the main takeaway from Jay Jacobs' insights?
The heart of the matter is that artificial intelligence and geopolitical events are driving major market changes. Jacobs explains that while big tech stocks have initially reaped the benefits of AI, other sectors will soon join the party.
Let's break down those key points, starting with the AI revolution. What's happening there?
Jacobs highlights that AI isn't just for the magnificent seven tech stocks. Sectors like semiconductors, electric grids, real estate, and utilities are poised to gain from the AI boom as they provide essential infrastructure.
Interesting. Now, how about the geopolitical impact?
Absolutely. It's not just the US. Over half the world's population is voting this year. These geopolitical events drive changes in manufacturing, supply chains, and trade relationships, nudging companies towards domestic and nearby production.
Fascinating. And what's the buzz on market dynamics?
Jay reveals a significant rise in U.S. manufacturing construction and infrastructure spending. Also, ongoing inflation, driven by aging populations and altered supply chains, is a crucial factor for investors to consider.
All right, crystal ball time. What predictions does Jacobs make?
Looking ahead, Jacobs sees AI infrastructure costs ballooning to $1 trillion by the decade's end, fueled by the need for semiconductors, data centers, and electricity.
And what about energy?
He predicts a significant surge in U.S. energy demand due to AI, electric vehicles, and manufacturing. Good news for sectors like utilities and electric grids.
So, to wrap it all up, what are the big takeaways?
Jacobs emphasizes the importance of diversifying investments beyond big tech stocks. The evolving landscape of AI and geopolitics offers significant opportunities across various sectors, and understanding these broader impacts can help investors navigate the future market better.
In today's video, Bob Quartermain highlighted the paradox of soaring gold prices but squeezed mining margins, emphasizing the importance of innovative technologies in mining. Nomi Prins and Brodie offered differing views on the Fed's influence, with Prins predicting gold to hit $3,000 and Brodie noting the importance of Buffett's massive cash reserve strategy.
Jay Jacobs discussed how AI will eventually impact sectors beyond the big tech giants. Stay informed, diversify your portfolio, and stay tuned for more insights.
They both see financial stability being very volatile due to eases with U.S. debt. They also both suggest commodities as a safe haven. Steve Hanke believes gold is the best safe asset. Doomberg prefers natural gas due to its increased use as a replacement for oil. Thanks for watching Financial News in Review for July 12th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.